So I've recently been getting a lot of questions about what is a better investment strategy. There's the BRRR approach or there's a flip. Now, I believe that it's actually dependent on the deal, first of all, and it's also dependent on your situation, and I'll explain that in a little bit. Now, before we get into too much detail about what the difference between the two strategies are, I'd like to point out one similarity, and that is both of the investment strategies require you to add value to the property. Now, I believe that there's three ways you could possibly add value to a property. The first way I'll mention is adding value through renovation works. You'll be surprised at what a little bit of paint and an uplift to a property can add value-wise to it. Now, it does require you to do a little bit of research. You do need to look at sold comparables, and those sold comparables preferably need to be in a good condition, and that'll kind of give you an idea of what you could get for your property if it was in that condition. You'd also need to figure out what it would cost you to get your property into that condition. Now, if you're experienced and you've been on building sites a lot, you may be able to kind of roughly estimate that yourself. If not, it might be worth getting one or two contractors in just to quote you up. The second way you could add value to a property is by renting the property out. Now, this usually works best with commercial or large residential buildings such as HMOs or blocks of flats. But if you think about it for a second, if you wanted to invest your money into an HMO, say for 100K, would you not rather buy one that's fully tenanted, or would you buy the one that's completely empty in the exact same condition right next door? Most investors would obviously choose the one that's fully tenanted. Also, with empty properties, you've got to consider that you might have to pay a manager tenant finder fees, and you also run the risk of void periods. So for those reasons, it's fair to say that most investors would pay a slight premium for the convenience of a rented out property. The third and the quickest way of adding value to a property is actually by buying the property. Now, hear me out. If there's a property that's valued at £85,000 on the market and the vendor is desperate to sell, you might be able to help them out by putting in a cash offer and guaranteeing a quick sale, but at a little bit of a lower price. So you could possibly offer £75,000. If that offer is accepted, you've just made £10,000. So what exactly is the difference between a BRR and a flip? I'll start off by explaining the BRR strategy first, and it stands for buy, refurbish, rent, refinance, and repeat. Notice how the first three things I mentioned are all to do with adding value. You could buy a property using cash or bridging finance at a below market value rate, immediately adding value to the property. You could renovate a property, adding value through renovation works if you've got good contractors and you know what you're doing. And in some instances with commercial or larger residential buildings, when you rent the property out, you'll also add some value. And the idea is that you add so much value that when it comes time to getting the mortgage right at the end, that you actually pull out all your original capital invested. I'll give you some numbers for an example. Say, for example, you buy a property for £75,000. You then get contractors in who quote you £25,000 to do the build, and you all in at 100K right now. When the valuer comes in and appraises the property, you've now added so much value that it's actually worth £135,000. So banks in the UK will usually lend a 75% loan to value. So 75% of what the actual house is worth, it's now worth £135,000. Get 75% of £135,000. You're going to be essentially getting paid for a cash flowing asset. But that's easier said than done. Finding these property investments where you can pull all or more of your money back out are pretty few and far between, but it's definitely not to say that they're not out there. There's also other things to factor in when doing BRR deals. You should factor in rent. What rent are you going to receive from the deal every month? If the rent's too low and you end up having to pay out of your own pocket to pay off the mortgage, it's going to turn into a liability, and it won't be worth doing that deal. Also, what loan to value are you eligible for? Maybe speak to some mortgage brokers. Can you get 75% loan to value? What interest rates are you going to get charged? Will the banks charge you 7%, 10%, 3% interest? check these things before you decide to go through with a BRRR deal. So now I've explained what a BRRR deal is. I'll go over a house flip. So a house flip is a lot easier to explain. It's basically buying a house, adding value to the property and selling it, making a quick profit. So your returns are generally a lot quicker than a BRRR. House flipping, I'd say, is a tad more risky than the BRRR investment strategy. There's no plan B with house flipping. The plan is to sell the house and to sell the house as quickly as possible, because every day you're holding on to that property is actually costing you money. You should also consider the sale fees involved with a property transaction. Obviously, there's a lot of parties involved in a transaction of a property. You're probably going to want a good, reputable estate agent, one that knows the market well, one who knows what you'll be able to sell the property for quickly. You're going to want a good solicitor that can push the buyer's solicitors to make sure the sale process goes through smoothly and as quick as possible. You're probably also going to want a good accountant on your team to find out how you can do it tax efficiently. Obviously, you could be liable to a lot of tax if you don't do it efficiently. There's capital gains tax. So definitely speak to an accountant and have a good team all ready on standby. Thank you so much for watching this video. I really hope some of the information was useful and you now know the difference between a BRRR and a house flip, or you know what to look out for if you're doing either one of them. If you want to do one of these types of deals but you're not quite sure where to start, or you just don't have the time, visit our website and register for property deals. We try to get these types of deals out once a week. If you want to do one of these types of deals by yourself and you just need help assessing the deal, or you're a bit worried about the deal, visit our website again, contact either myself or one of the team members, and we'll be more than happy to help you assess the deal.